Thank you, Nicola, for coming all the way from Mumbai and agreeing to do a recording. The whole idea of this meeting is to, which you have done earlier also. Actually, we want to hear from you saying, okay, what is about the budget? Where do you see things going on from here? What's your market outlook? Is the fall over? In general, we want to keep it very conversational. And I'm joined by Naveen Shetty, who's the CIO of the firm, and Mohit, who heads the investments and growth. So they will all ask you questions. I hope we will get a lot of insights from you.
It is all mine for inviting me across. Please feel free to ask me whatever you feel like asking.
My first question is, we all know what is the big takeaway from the budget is the tax break, right? So what are your thoughts on that? How do you rate this budget?
So let me start off with the fact that I'm sure all of you guys are remember the Chidambaram Dean budget of 97, right? That was a shocker for everybody. I mean, cuts, rate cuts, excise cuts, name it, it was like on the platter as such. I think this budget was not on that scale, but somewhere there. And I'm not just talking about the 1 lakh crores which was given away. I'll tell you the implications of that 1 lakh crore when I come to that. It was about the way the whole budget was formulated. I would say it was like a magic budget which came about because she didn't only give away so much to the taxpayer, but she also made sure, when I say she, I'm talking the finance minister. The finance minister also made sure that the wasteful expenditure is curbed. Those days of ready subsidies are over. The question that everybody asked was, why didn't she spend so much on infra? I mean, why the capex was taken away? If you look at the nuances of the budget, you can only spend that much on railways, only that much on roads. Right? Big expenditure, I think, is pending from the state side. Because from here on, if they spend, and then that's what the post-budget meetings, the bureaucrats told us, that look, you can't just go on spending wastefully just because you want to give employment, right? You only made so many roads. You can't make a road which goes from nowhere to nowhere, which some of the states are already doing. So that's why they want to curb that. So this is now we want to push the states to do things on their own because land acquisition is a state subject. So that's why if you look at the overall spend, it's 15 lakh crores, not 11 lakh 20 that has been put down. Because the bulk of it is going towards this loan to the states for capexes, right? So as and when that comes through, that will be seen how it goes. Unfortunately, the states nowadays are on the path of freebies because they've seen that you win elections, you need those kind of freebies. So I think that instinct has to be curbed somewhere, and then probably things can take off. So anyway, the good part was that she saved and she conserved, and the fiscal prudence played its part, right? So keeping that deficit at 4.4 when everybody was expecting 4.5 was again a big move forward. Basically, it sent out a signal to the RBI saying that, look, I'm not going to borrow so much from the market, so you can be free to do whatever you feel like. Now, coming to that 1 lakh crores of SOPs that were given away in terms of tax savings. On the face of it, 1 lakh crore on the base of India's GDP of 185 lakh crores doesn't look that big, right? But let's look at the velocity of money, which is calculated by 1 divided by 1 minus MPC. MPC is marginal propensity to consume, right? That's basically the inverse of your saving rate. So that works out to around 5 times. 1 divided by 0.2 is what it works out to. So 5x. Now we apply the factor of 5x to 1 lakh crores, we're talking about 5 lakh crores. Now, the consumption GDP this time around is supposed to be 104 lakh crores out of the 185 lakh crores. So 104, 5 divided by 104, 4.7%. The consumer GDP this year is expected to grow at 7.3%. 7.4%, sorry, talking about this year, fiscal 25. The overall GDP growth is 6.4. Okay. Now, next year they've estimated the GDP to be at 6.3. You apply the same factor of discounting, the consumer GDP is supposed to be 7.3. Add this 4.7 to the 7.3, we're talking about 12% consumption growth in GDP. Now, that's a big number. Overall GDP, 185 lakh crores, divide 5 by that 185. You're talking about 2.7% impact on the overall GDP. Add 2.7 to 6.3, you're talking about 9% growth in GDP. Now, those are the numbers that will shake up the world. Yeah. It looks very unbelievable that 9% kind of GDP growth when the nominal GDP projected is 10.1, right? So now You look at the tax collections that has been projected in this budget. It's around 14 odd percent. Isn't time with the 10% nominal GDP growth, 14% growth in taxes when the nominal GDP is going at 10, is she going to increase taxes? No, she's not. She's in fact given you a break, right? So where's the disconnect? The disconnect is exactly this. She's expecting the nominal GDP to be at 14. She hasn't put that down in so many words, but that is what she's expecting. And now you tie up that 14% with that 14% growth in taxes, the nominal GDP growth, because you're talking about a base of now 9% and not 6.3, right? So that's where everything ties in, I suppose. Government is hopeful. I'm not saying that the consumer will straight away start going and spending. Yeah. Because today the consumer needs some kind of comfort. He needs to see some job stability. He needs to see new job creations, which can only happen if the private sector capex kicks in. Unfortunately, that is not what is happening. Now, that's where the RBI role comes in. Because today, the real real interest rates is around 1.5%. Normally, the RBI has worked with 75 to 100%. 100 bips, is what they worked at, right? It's 150 bips today. Now, to change that, he can do a lot of things, because right now the money is scarce. The cash is scarce in the system. That's because the RBI has been earlier, the government had been sucking out liquidity to manage the rupee. I think ultimately the RBI has taken the call that, look, I'll bite the bullet, let the rupee go. You've seen how it's going, right? And that's what they're doing. So their major focus is to infuse liquidity by way of CRR cuts, which they already did, by infusing more, rupees into the system, by buying dollars and selling rupees. That's what they're doing also. So and I think the seventh policy, one has to wait for a shocker again. My feel is that there's another shock needed for the system to be shaken to believe that, look, the government is there behind you, the RBI is ready to do whatever you want. So I won't be too surprised if he takes an interest rate cut. 25 bips is probably the minimum that he'll undertake as such. And if he was really sincere about shocking, I think 50 bips is the right thing. But that's too much. I think RBI will shock itself when it does that. So.
I have multiple questions to that.
Yeah, I think you preempted some of my questions, but I think part of it I'll ask, like regarding the government's shift from capex-led growth to consumer-led growth.
I told you the reason. Right? They don't have many avenues to spend anyways. The biggest problem is land reforms. Because the land reforms are state subjects. The problem with them is that, like if you want to do the last mile in highways, it is state level call. Yeah. So that's why railways, last mile, again, state level call, land acquisition, right? So that's why they left it to the states to decide. Now you take a call.
Has this 11 lakh crores hit a ceiling? Like if government wants to even spend more, they cannot.
No.
Or is the multiplier effect expected from government capex? Is it not coming there? That's why they're shifting. Those things, and also regarding this now the shift from capex to consumer, how should the stock market view it as, like the usual railways and shipping or defense? They might be doing well, but the growth might not be there. What is your thought?
So basically I think that 11 lakh crores is probably for a while is the plateau that you'll see from. The states put in an effort. Then I think it can be huge. It can be like 20 lakh crores if the government needs it to. So that way. That's why I don't think they were conserving. I mean, she had enough to spend. She could have. In fact, this year also there's RBI surplus is supposed to be around 2.4, 2.5 lakh crores. So they got the dividends from RBI. So that's going to be huge for them. So that way. So I don't think that was a problem. I think the problem was what to spend it on. Yeah. The call had to be taken that is it going to be wasteful or is it going to be useful? Yeah. So the wasteful spend is now out. And that's why I like the budget. Coming back to how to play this, I think railways and defense did get its share of spends. But the problem with defense is the technology transfer. That is not happening the way they wanted to. I mean, you see in Hindustan Aeronautics suffering because the technology transfer on the engines part is not happening. From I think it was General Electric, GE was supposed to pass on. It's not happening. So they're constrained on that front. So I think that is where the problem arises. Otherwise, defense can absorb quite a bit. The good part is that India can be outsourcing based because we're a very friendly country towards even the most arrogant of neighbors we want to be friends with, right? So India can be a good source for defense outsourcing. So I think that's going to be out of the way. I think this time around it's going to be a consumer-led move in the market. And when I say consumer-led, I'm not talking about the FMCG kind of consumers, because if you save me on your tax, doesn't mean that you will take bath 4 times a day or brush your teeth 5 times a day or something, right? You buy new clothes, you buy new shirt, cars and houses and stuff like that. So that's what's going to happen. But for that, it'll take a while, because my feel is right now the money will go more into savings. Because as I said, that comfort has to come in, and I think RBI has its role to play there. Because once they start doing rate cuts and infusing liquidity, that's when the private sector will also believe that, look, now is the time to start spending. I'm getting money cheap. Let me build up more capacities, plan for the future. That's what's needed right now.
Before Mohit takes over, I have a question around 1 lakh. So we're all focusing on that 1 lakh rupee.
Right.
There is also, I believe, 3 lakh crore of welfare schemes that have been announced in these states.
Yes. Those are, yeah.
Right, it's amounting to about 3 lakh crore is what I believe. Right, so will that also have similar impact in the 1 lakh?
So no, not really, because this is mainly focused towards a lower income, the Ladli, Ben, and stuff like that. Right, we're talking about those kind of. I won't call them wasteful, but I don't think that the velocity is that big as what you leave it in. It's like a company which is holding cash and a company which decides to pay out dividends. Right? So I think that is what is the problem here. If you, like company, we're talking about the government of India, if they decide to pay out dividends by way of giving away tax breaks, that has a major velocity, because these guys are the ones which are really spending. These are the ones which are. I don't know how many of you saw the NSO, National Statistical Organization survey, which came out in December of 24. The survey happens every 10 years. Last survey was supposed to be in 21. 11 it happened. 21 because of COVID, they didn't do it. So they now did it now recently. And all along I knew that the households were spending less, but I thought it was the poorer households which were spending less. What I couldn't correlate it to was that why is it that with the poor household not spending, the economy is suffering so much? Because these are not the guys who are moving their ticket in the economy. Right? It's going to be the middle income and the higher middle income. The NSO survey proved me otherwise. It was the middle and higher and middle income which had stopped spending. There the cuts had happened. Because they always used to lever. Right? The earnings used to get leveraged by banks and NBFCs and stuff like that, gold loans or whatever it be, and they used to use that to spend. It was not knowing the cash in the pockets. The problem was when RBI decided to control the rupee, they had to control the flow of money, right? Because interest rates can only help you that much. Beyond that, you have to control the flow of your rupee, right? And the best way to do that was, one was obviously sell dollars and suck out the liquidity, and the second would be to tell the banks to stop lending, right? And that's what happened. The system went into freeze, and that's where the consumer really suffered, and that's why that urban consumption dip was purely because of that. But for that dip to come back, it's very easy to curb the buying instincts of a consumer, but to get him back on track, you need a shock treatment. And that will take a couple of quarters. I don't think it's going to happen overnight. So that this saving, that's why I said the bulk of the money I think will go into savings rather than into spending today.
Do you see around 6.3, 6.5 GDP growth and all? We need 8% for. Forget the Viksit Bharat, even to employ the people coming in. Is there some push going to happen there, or it's a big shift now?
China opened up for outsourcing in 87. In 89, India and China's GDP were more or less similar, $230 to $240 billion, if I remember right. China started becoming the manufacturing base for the world, and they started galloping ahead. But they galloped ahead only that much. In a decade's time, their GDP was $1 trillion. Ours was $500 billion. We doubled it, quadrupled it, right? So that gap was 1:2. From 1:1, it became 1:2. Right? By 2000 is when they hit the same per capita as what India is today. $26, $27. That's when the internal consumption kicked in for them. Consumption kicked. After that, you've seen the GDP. It's $20 trillion. And we are $3.5, $4 trillion. 1:5. Bit of the gap opening up. That gap opened up because of the consumption. And that's where India has to kick in. Capex can only lead you to that much. Beyond that, it has to be your consumption kicking in a big way. And today we are bigger than China in terms of population. So I think that is where the government is coming from, that look, I can do only this much. Now, how does that work, right? Job security is one which makes you, spend more. Right? For job security to happen, jobs have to be created. For jobs to get created, you have to have fixed assets. That's why services can only employ so many people. But once you create real infrastructure, that is when the real employment cycle kicks in. The ancillary industries which has keep coming. Right? And that is where I think the industry has to now put in their muscle as such. So start spending, and I think this, let's see what happens on 7. I've got a lot of hopes from RBI of how to push that across. So I think they'll have to carry that agenda forward, otherwise the whole effort will be lost.
Double shock.
Yeah.
But to the point of currently the corporates having a lot of cash on the balance sheet,
Right.
and they are more or less levered to the debt.
Very true.
Why is there no private capex happening as of now?
Because so as I said, urban demand collapse, right? So if you see, suppose I'm a manufacturer of ACs, right? I know that the people aren't spending. Why would I have set up more capacities in ACs when I know that my existing capacity is going to be lying idle? So that's why I said that RBI has to give them a shock. Instead of say, look, I've already pushed you guys. I'm pushing the consumer also. Let's start doing something. You're planning for the future. You can't wait for your capacity to hit 100% before you start planning for further capacities, right? So once he sees a pickup happening, that's when he starts building in more capacities, which is not happening today. In fact, they're raising money to repay the loans. They want to be debt free. That's what's happened, right? So because they're working capital loans, they're repaying all that unsecured loans that they have and stuff like that. They don't want to take any chances right now. But when you see money becoming cheaper, that's when you can take a chance. You can say, okay, now that the rupee is cheap. As I said, if your real interest rate is at 150 bips higher than your actual inflation, you will be wary to spend, to cover that kind of a cost. I'll take a lot of time, right? So, but once you see that cost of money coming down, that's when you say, now it looks nice, right?
So you're literally motivating me to save than invest when the real interest rates are
high. Right. Exactly. Same as individuals and corporates also.
Given the current situation wherein whatever the GDP is at the current valuations, if some investor wants to earn 15% over the next 1-2 years, where do you think, what should be the strategy?
So, okay, earning 15% over 2 years is not a problem. I think he'll earn not annualize 15%.
Annualize 15%. CAGR of 15%.
I was going to catch you there. So that's what I said. No. So here's the thing. Okay, I think the last 3 years were actually an aberration.
Yeah.
You just came out of COVID and you see those 25% kind of CAGR returns. Not going to happen. Last 25 years, average is around 10%. I think we're going to come back to mean. But for us to come back to mean, the last 3 years also have to adjust.
Yeah.
So probably for the next 3 years, you'll see single-digit kind of returns. Right? Now that's where the role of the alpha manager comes. I'm not saying that the market will grow at say 5-6% or whatever, and the rest of the crowd also will grow at 5-6%. The alpha guy will have enough and more to pick his stocks. Right? And basically, why I'm saying that is like from peak to bottom, right? The index Nifty 50 has corrected 13% or so. The median correction in the 13% correction for the 50 index for stocks was 19% price correction. Not too different from the index, right? Come to the mid cap index and the small cap. They both had corrected something like 17% from peak to bottom. The median correction in the mid cap index was 30%. That means some of the stocks would have corrected 45-50%. In the small cap, that same median was 32%. So again, 45, 50, 55%. This is where the opportunity lies. This is what you want to see. Small cap, fortunately, there's enough and more to select from, because anything beyond the 250 is small and micro cap. So you can take your pick depending on your comfort on the stock, the management, the valuation, the growth, and everything. Right? Coming to the large cap indices. Okay, so now let me talk about the global scenario first. Okay, so India in September 24, so in MSCI India, right, which is Morgan Stanley Composite Index for India, was at a premium of 24% to the MSCI World Index, in which US is 65%.
This is at
September of 24%. The 10-year average, the premium India commanded was 14%, which again everybody felt was very high, right? And that 14 became 24. From then on, there has been a correction happening in India. Plus, the world has been strengthening, right? Today, that premium is down to 4%, just 4%.
Below
the 10-year average, and massively below. So anyway, even if you tell me that 10-year average was a skewed one because the last 3 years were very bad, very good for India and can't repeat, fine, at least give them 8-10% kind of averages, right? Not 14. Still, you're too far away from that. And that's why now you've seen some nibbling happening on the FII front towards India as such, right? So that's where they've also seen this. And these are all con guys. They're these master strategists who sit in the US and say, okay, India is looking cheaper now, move some money here from this market to that market. That's what's happening. The big money is not flowing in, right? It's small money which is nibbling at our feet as such. So that's on that. That's on the global basis, right? That's why we're looking pretty decent now as compared to what we were looking earlier. Come to the large cap indices, right? Now the large cap index at the peak valuation was 21.5 times Nifty 50 I'm talking about. With the recent correction is less than 18. Right? The last 10-year average has been 21.5 if I remember right.
This is 1 year forward.
Yeah, 1 year forward piece, right? Even the MSCI which I was talking about was 1 year forward. So that's 21.5. The last 15-year average is around 18. Or 17.5, sorry. 17.5 was the last 15-year average. We are there. We're not too far away. Right? And anyway, the growth rates in the large cap, I never mean the question, is 8-9% growth, which is decent growth. If you take off the oil and gas sector, which has been suffering, it's 14%, which is what you need, a mid-teens kind of growth for you to support those kind of valuations. Right? So we are home and dry in the large cap space. The problem lies in the mid caps. Small caps to a very small extent, but mid caps primarily because mid caps normally used to quote at a premium of some 15 or 20 odd percent to the large caps, but today they are 40%. By the way, those premiums are down to 80%. Now they're down to 40. Growth rates are not that great out there. In fact, growth rates are negative. So that is the area which has to correct. And by the way, within that also, you'll be surprised to know that I think of the 150 stocks, some 30 odd stocks accounted for 60% of the rally all the time. It was only the 120 stocks which are laggard. So here also you have pockets of valuation which is lying there. In fact, if you look at my portfolio, I've got a few mid-cap stocks which are looking pretty decent in terms of valuation. So I think one has to be a chooser and pick out, yeah. And I'm sure the alpha manager will give you a far better alpha as compared to those 4-5% that he used to give, because these are the times when you can really generate alpha for the long term.
From a segment perspective, how do you rate large, mid, and small in the order?
So obviously my preference first will lie with large. That'll be my number one. I mean, if you see my portfolio, also large caps take a big chunk of my portfolio. Small caps follow next, and then the mid caps part. Though mid caps, as I said, there'll be pockets. So I'm already looking out for options within the mid cap to start building on that. Today, if you see my flexi cap fund, it's more or less similar. The mid and small cap exposure is almost 20% each.
To that context, so you said, this is the year of, or the coming years are the years of alpha managers, right?
Yes.
And you said 8%, 9%, maybe you'll be surprised with those kind of numbers. But with higher exposure to large cap, you still think that is possible?
Yes, because as I said, the valuation in the large cap have collapsed quite a bit.
Right.
Unfortunately, the market painted everybody painted the whole caps with the same brush. Ideally, I should have seen a bigger correction in the mid caps. But since they fell, the large caps also fell along with them. Right? I think that's what has made it more appealing to get into large cap space, because the valuations there are much lower than what your averages are telling.
And one to ask more question on what Naveen had asked you, right? So you said we may be surprised on the GDP front also.
Right.
That could be a big number.
Yes.
So that could translate to higher index also. While I know averages will happen, it has to.
No, it will. You're right about that, because normally the index is a representation. It's a better representation of GDP because the index doesn't have agri. Right? Agri is the one which always pulls down the overall GDP numbers, where you go 3-4%. Right? The services and manufacturing are the bigger chunks out there. So that's what your index is a representation of. So normally the index gives you 2-3% alpha over the GDP itself. Right? So that's what's going to happen. So I agree with you. Yes, the index will surprise on that.
So that surprise plus alpha managers adding significant alpha
Yes.
could mean good year for active investors.
Yes, active fund managers. Yes, this year will really separate the men from the boys. Because thus far, quite a few managers haven't even seen a bear run. I mean, they've seen just a full market and they believe they're gods because they bought one stock and just went up, right? So, and you've seen that, right? I mean, quite a few funds which are heroes of last year are already languishing at the bottom of the pit as such.
Regarding one more elephant in the room is Trump, though
elephant, I like that.
though their tariffs might not affect us much, I think dollar and US interest rates might either play a spoil sport or might be an. Where do you see this? Do you think some stability coming up sooner?
So basically, Trump, I call him a loose cannon. Actually, he is. I'm sure he also doesn't know what he's going to wake up in the morning and say. Right? I mean, it just happens. I mean, nobody will expect him telling that Gaza, I think, belongs to us. We go and occupy Gaza and stuff like that. I'm sure Benjamin Netanyahu also was surprised about that. Anyway, but that's the problem with that guy. Even on the tariffs front, just one phone call from both the leaders and he reversed the tariffs. Even China, I think, is waiting for a call with Xi as such and he'll reverse it. I don't think that tariff was going to happen. I think the world hasn't taken it that seriously anyways. It took it for that particular day as such. But the next day when he reversed it, they realized that it's just a card that he's trying to play, right? So that's about Trump. But the fact is that the dollar, all his policies are inflationary, right? If he had gone around with trade, by the way, all bets would have been off the table because then you're talking about a heavy inflation scenario globally, not only any other country but globally. But in a way, US would have been insulated because if your dollar strengthens against other currencies, I mean, you saw that, right? Other currencies collapse against the dollar. That's a very smart thing to do because what happens is most of the commodities, all the commodities are denominated in dollars, right? They trade in dollars. So his dollar will fetch more or the similar amount of commodities because he's not impacted, right? He's going to print his money. Right? But the outsiders, the outside countries, beyond that dollar, they are the ones who will suffer. They're going to pay more for that same commodity. The rupee, the currency is weaker. In a way, he's exported out inflation, insulated US from that. The only way he can suffer is if there's labor inflation, which is homegrown, which he cannot export out. That's why he's making sound bites about throwing out illegal immigrants. He's doing it in bits and pieces. It's not a huge amount that he's doing. He knows that will kill his economy if that labor inflation happens. So that way there's some sanity out there. So that is the only thing. Otherwise, I mean, dollar, I think if US is strong, it's good for the world. Right? They are the biggest consumers in the world, accounting for 25% of global flows into trade and stuff like that. I think we need a strong US. I don't have any doubts.
But how would it affect India? Because we saw when the interest rates there were higher, there was a FII outflow towards there, and dollar being stronger.
So
those FII outflows. And plus we import a lot of things, right? China it might help. So does that affect too much for us, or is it?
No, I got what you're saying. So that's why I said that he doesn't want inflation. Right? I think the strengthening of the yield curve out there, they went to 4.95. The 30-year bond yield. Now today is 4.7. So I think they've also realized that he's not that crazy enough to do this. Right? So that's why that I would say that 25 bips has gone away, right, in terms of the bond yields, which is a major deal. On a base of 5, 25 going away is a major deal, right? So that's what is happening. So I don't think that's a concern right now. The concern is the rupee today. And all the FIs can see that, right? I mean, they know that the rupee was held up artificially. I think the panic selling that happened on the FI front was because of the rupee and nothing else. Because they knew that that's going to tank, right? And if it tanks 4-5%, you're going to take a hit of 4-5 when your market is not doing anything, right? So they call that, look, move the money out, park it in somewhere safe. We come back to India once we see a stabler currency as such. So my feel is that, again, I mean, this is just nibbling which is happening today. But they may come back in once the rupee is closer to 89, 90 or so. And I don't see that being too far away.
Gold, what is your thought on that? Is the run up over? Is it still there?
So gold has been a totally outlier when it comes to returns as such, right? Bulk of the returns came during the COVID period. I mean, if anybody bought gold earlier, you would have made money till COVID hit. Yeah. So that is what the thing was. And gold is I think it's more of a insurance trade. Right? When there's so much of uncertainty, get into gold as such. And with the way the US dealt with Russia when the war broke out, I think that was the last straw on the back of all Soviet countries, because they realized that, look, if your reserves can be blocked, Soviet reserves can be blocked, you might as well hold gold, right? No T-bills, no cash in other foreign banks, you have to have gold in your own vaults. And that's why India, this is now, by the way, India is not, so the gold that you see which is coming back to India, that is India's gold, which has been lying in the Bank of England, not for anything else, but because when you buy gold abroad, it's called as good for London. GFL is what they call it. When they quote a trade price, it's GFL price, and that's good for London. So all gold goes and lies in the Bank of England. Every country holds gold in the Bank of England. Right? From there, you're supposed to import it back to the country, so that you pay some 0.04% or something annually for them to hold that thing. So that's what India is doing now. It's getting its gold back in because they're not also worried, what if tomorrow something happens and they hold my reserves back. So might as well. And China went overboard in buying gold. They were buying gold practically every day, a couple of tons every day, and that's what was the prices. So I think till the time the uncertainty continues, gold prices will remain firm. I don't see them letting up as such. Already what they're 2,800.
Yeah.
So I don't see that.
But to add it up to the gold, how do you think about silver?
I don't have much clue on silver, but I believe silver did far better than gold last year.
Last 2 years.
So maybe it's again a derivative trade here. So it's like the derivatives that you have for single stock futures. I mean, this is a derivative of gold, whatever. I don't know. I don't have a call on that one, but I'm sure it will move in tandem with gold.
So next question, I think you partly answered, but I'll break it up into two discrete questions. How do you see the valuation now in the stock market? And going forward, FY26 and forward, how do you see the earnings growth? Where do you see the niche? Where do you see nothing is going to change or things are going to be?
So let's come to the earnings growth part, because that I think is much more relevant right now when I talk about valuations, right? So basically, the earnings started tanking in a very nuanced manner in March of last year. Not tanking, but waning. The growth rate started waning from March onwards. December was a pretty good quarter. The growth rates were waning, as in they were growth, but still you didn't see that excitement in growth. Growth took off, as in came off quite sharply in June. September was a negative quarter. December is no different. Our feeling was that probably December will be a trough quarter. And that what we didn't call out was that the massive drop in the urban demand. We thought the rural demand was picking up. So as a result, the December should be a trough quarter. But we didn't realize that the urban demand collapse would be so sharp. It started in September and was accelerating into December. In fact, I met quite a few consumer companies, and they were telling me that, look, the amount of footfalls that you see in retail outlets is going down. Today, one of my colleagues got this bottle of coconut water, which was manufactured in September of 24. Cash on also selling out. So these are kind of impulse purchases, right? So when things are not picking up, this is what you check. Actually, I used to do that when I was an analyst. I used to walk into a store and, in front of the cashier, they put these chewing gums and chocolates and stuff like that. It's a pure impulse. So if a guy is buying something, he says, chalo, ye bhi le lo, right? I should pick up those and look at the date of manufacturing. If the date was like 6-7 months old, I knew that, things are not moving.
That's a good way to look at it.
So I still do that, but nowadays I don't go out that much. But anyway, whenever I get a chance, I do that. But anyway, so that's what it was. So it's obvious that impulse purchase is not happening, and that's why the economy is going to slow down. So December is not doing great at all. March, again, I don't see much of a hope in March. I was hoping that March would be a tough quarter, but March last year was a strong quarter. So that's why YY numbers will not look that great. June onwards, we'll see a trough happening. As I said, consumer confidence has to kick in. If that starts kicking in, you'll see June as a trough, and then probably from September onwards, the YY numbers start kicking in. And I think the FIs are waiting for that. Big money is waiting for that growth. You want to see that growth kick in, because if you're giving a premium to a country, you have to see growth there. And if they start seeing that growth, they'll come back in force. So that's what's going to happen here. In terms of valuations, I already told you that the large caps looks pretty reasonable. The mid caps look stretched as of now. But there again, pockets are looking stretched. There are still pockets of real value lying out there. And obviously, the small caps are more or less in sync as such. So we are there somewhere. But only thing is, to excite real good money, you have to have that growth kicking in a big way, which is not going to happen.
Any number that you want to put on the EPS growth?
So my feel is that the large caps will grow their earnings. So this year, so okay, let's talk about December. The large cap, the Nifty 50, the reported, I think 30 odd stocks were reported numbers till now. So the growth there is, the PAT growth is 9%, right? The profit, which is not bad a number.
Yeah, exactly.
And if you remove the oil and gas companies, it's in teens, 14, 15% kind of growth. The oil and gas companies are the ones who are dragging down the overall growth of the Nifty 50 companies as such. So that's not a bad number at all. But that's only this much, right? These guys used to go at 20% plus. Now it's like 14%. So that, and 9% actually, if you look at the overall numbers per se. So I think that number has to pick up, but it won't happen in a rush because now the base is becoming much more stronger. So wants to wait on that. So okay, finishing off this thing, I think this year will be a single digit kind of growth, as in
25?
Yeah, 25 this year. This year, in 26, if things work out the way they are, you'll see some kind of low double-digit kind of growths, early teens kind of growths, 11, 12% kind of growths is what you may see.
It's about 50.
For Nifty 50. The broader indices, I think, will suffer. There the growth will be, because the NSE 500, if you see, I think that will see not a compression. This year, maybe a flattish kind of growth, zero, if you will. But next year, you'll see some mid-single digits kind of growth as such. With that, venom has to come out for.
Like you said, hopefully RBI will give us a good surprise.
Yeah, hopefully.
One more surprise can we expect from the GST Council? I think sometime this month they are meeting, right? Would that come in?
Yeah, you're the second person asking me this. Today again, someone had asked me. My feeling is that GST is not a one-man game. It's 30 states which are controlling that, right?
Yeah.
So the problem with that is to get that consensus going is going to be a tough call because each one will ask for his pound of flesh.
Yeah.
Already you've seen, I don't think it's going to happen because already you've seen that the FM, what she did was I don't know how many of you noticed, the high-end goods, the duty cuts that she's undertaken, she's converted them to cess. Like 125% duty has been cut down to 70% in luxury cars, but she's applied a cess of 55%. So the cess remains with the center and doesn't go to the state. The duties are shared with the state, right? Respective states where the cars are getting poured into. So I think she's playing that card. So I don't think the council is going to surprise in any way. They may tinker around here and there. You can see, you saw that how much time was wasted on caramelized popcorns. So that is where the problem.
Off track. I have lived in the US for 15 years and I have seen that they are very careful about what narrative goes out. Did this popcorn stuff make the urban consumers reduce their spending? Like all of a sudden somebody buying a car starts calculating 28% of my money is going in taxes. Should the government be careful about the narrative those things create, especially when urban consumer is driving the economy so much?
No, you're right about that. The fact is that urban consumer is aware. In the back of his mind, he always calculates that of the 12 months that I work, 7 months I'm working for the government. It's only 5 months that I'm earning for myself. Now that 7 has become 7.5 by the way. So that all keeps happening. But I don't think that curbs him from spending. Right? Because spend is as your purse becomes bigger, you want to live good. Right? You want to have a healthy lifestyle. You want to have good healthcare and stuff like that. I think that is a different narrative out here. Yeah, it makes you wonder about the sincerity of the government when they start debating on whether caramelized popcorn should be taxed at this much or that much or whatever. Just goes to show you how much waste of taxpayers' money is happening in discussing all these things, right? And ultimately, what is the revenue stream of 4 crores, 5 crores here and there, so that way. But yeah, I mean, I don't think that's what's holding them back.
So one point which you mentioned is the growth within the corporates can be seen from the second half of the calendar year 2025. Now, if you want to give a suggestion to any investor today, where the markets have declined in the month of January, there could be some kind of a retail planning here and there. Because the stocks at the individual level are under 40%. Now, if you want to give a suggestion to them, what action should they be taking right now? Because if the FIs are waiting to enter the market, let's say second half when they start seeing the
Growth
earnings coming in, what should the investor do?
So basically, one thing is that stop investing in himself. Go to professional managers or the advisors like you guys. That's one thing given because the market is going to whipsaw. It's going to be a very confusing market. See, I could have told you that the markets are going to be dull. It's not going to be that way. It's going to be whipsaw. You saw yesterday what happened.
Yeah.
2% up. Today it's like flat. It was up 1%, came down so sharply. Tomorrow it may be down. It's going to be like a whipsaw market. And this can really kill the investor. He may get hit from... I don't know how many of it, riptide, right? You never know where the tide is going to come from. It's a riptide. It can come from north, south, west. That's the scenario that we are in today. So please go to professional managers, and if you're looking at doing investing, make it a full-time job. Don't think it's a hobby that you're undertaking. It's not going to be that way. It's going to be a full-time job this year in investing. So take help of professionals and be with them. If you want to invest, stagger it. Don't go and whole hog now. Please stagger it for the next 3-4 months if you want to do that. Really feel sorry for the investors who stop their SIPs at this point in time. Because this is the time when you really can generate alpha on your SIP. This is the time when you can really get a real alpha going forward. Because you're averaging it close to the bottom.
Actually, that was my actual question. That we have seen the data coming from NCVP that the cancellations of SIP have just increased.
Yeah.
So, what should be the thought given to the investor at this point is either start accumulating at a lower base or wait and watch, try to time the market.
So, timing the market, nobody can time the market. Right? I mean, as I said, I've been in 30 years in the market and I still don't know when to follow the top or the bottom. If I've done it, it's purely fluke, by chance and not design. Okay? So nobody can do it that way on a regular basis. So might as well be there with the skin in the game as such. Continue with those SIPs. Because at this price only is the SIP that really gives you a real kicker, right? So that way.
There are also these investors who go like, okay, can I sell now? The market is going down, buy back.
No, can't have.
Which is impossible to have. Have a skin in the game.
I'm sure the guys who had stopped their SIP would have started yesterday. Right? And they were, what did I do? I bought it at a high price.
This 4 years, or looking at the rear view, 4 years has been a good bull run. What do you think about the next 3 years? Whatever currently is happening, is it just a blip in the bull run? Will the bull run continue, or is it a trough?
I think if you stretch on an overall time period, that blip will be like this.
Yeah.
A small tweak in the whole run. But the problem is that what to do about the next 3 years, because you already given a return of 25% CAGR in the last 3 years. Right? Now, ultimately, they have to come back to the average, which is 12%. Right? So, for that average to happen, the next couple of years have to be in single digits. So my feel is it's going to be a single digit. And unfortunately, the earnings growth also is not kicking in. Well, ultimately, the markets are slaves to earnings growth. If that had kicked in, they would have very well continued that trajectory. But that's not happening. Obviously, bases have to now correct somewhere for that earnings to pick up. So probably 2 years of semblance, and then probably we'll see something happening later. So
that base correction also, which you mentioned, primarily we see in the mid and small. but the excesses have already happened.
Right.
Within the large caps,
Large caps anyway didn't rally that much.
Yeah,
Right?
exactly.
Even they didn't participate that much in the rally as much as the mid cap and small cap did. I think that's what spoiled the investors' psyche and expectation that 25-30% is a given in this market. Not.
I mean, I had an investor who need 20%. Okay. This much it was good.
Couldn't say 20% per month.
Exactly.
There are schemes going around.
On that note, I would like to thank you so much for all the insights you have provided. It's been a long, good, insightful session, as usual, and I always look forward to this. And I hope to see you soon in Bangalore. Thank you so much.
Thank you. Thank you for having me.
Thanks a lot. It was a great session.
Thank you. Enjoyed.